Before we break down all the nitty-gritty details about Oracle, want to do a quick shout out to the sponsor of today's video, Fiscal.ai. One of the greatest things about Fiscal is the speed in which those numbers get updated after earnings reports. In fact, we're recording this just a couple of hours after Oracle reported their earnings, and we already have KPIs.
Like these ones right here for Oracle, if you're trying to get a handle on the breakdown between the company's new high growth cloud business and the old legacy software business, these KPIs on Oracle and lots of other businesses are definitely what you need to get a full, well-rounded look at the business you're interested in investing in.
We use Fiscal.ai every single day here at Chip Stock Investor. We even have it embedded on our website as well. You can get 15% off any paid plan, fiscal.ai/CSI.
We are going to talk about Oracle. And this first slide is the most important slide you'll see all week. It is the meme of the week.
Bam.
There are some big things that happened. Bam Adebayo scored 83 points, surpassed Kobe Bryant's second place record for most points, still behind Wilt Chamberlain, but 83 points in a game. But he plays for the Miami Heat in 2026.
And they're having an okay season.
Second big event that happened last night, Oracle Cloud, 44% year-over-year revenue growth. Wow, incredible. One of the fastest growing hyperscaler businesses, but
they play for Oracle.
They play for Oracle, the legacy software business in 2026. And they're having an all right year, but anyways, let's talk about what happened specifically with Oracle. Much as we'd like it to be, this is not a sports show.
This is Q3 fiscal year 2026. So it's in the middle of the year. They have some great numbers here, high year-over-year percentage increases that we really need to take the weed whacker to understand what's actually happening, cut through the propaganda, and drill down on this a little bit. This is the RPO number, remaining performance obligations, $553 billion, up 325% year over year in USD.
And almost 30 billion quarter over quarter.
They keep adding to this number.
Bam Adebayo numbers.
Exactly. The fourth bullet point down, Q3 cloud revenue, 8.9 billion, up 44%. And they break these segments down in the most confusing way possible. Right, Nick? It could be easier.
And it's been this way for a long time. Oracle, whoever's doing your press releases, I know you've got someone in here from your PR team watching our stuff. Put sub bullet points underneath this just so that it indicates that what follows item number 4 is a subsegment of what you just stated. It's super confusing. Anyways, it was good though. Of the 8.9 billion, 4.9 billion was the infrastructure as a service part of the business, IaaS, up 84% year over year. That has been the highest growth segment for quite some time for Oracle. So that's great.
Just down at the bottom, the Fusion Cloud, that's for large multinational companies. And then the NetSuite Cloud, that's for smaller companies, just as a reference.
And ERP is enterprise resource planning software.
Let's look at this on earnings per share basis. We have that highlighted in yellow, up slightly more than overall revenue growth. Non-GAAP is on the left. But if you take a look at that on a constant currency basis, if you exclude the benefit of a falling US dollar over the last year, which helps international revenue when they convert that back into USD, it's actually just 16%. That earnings per share actually grew slower than revenue.
Mm-hmm. The cloud business, infrastructure, and software doing very well, 44%, dragged down by the slower moving legacy part of the business. So overall growth was 22%. And so on a constant currency basis, earnings per share are growing more slowly than revenue. Now, that's not surprising. We have higher depreciation expense because of all the capital expenditures on the data center build out and related equipment. But it's something to call out here and bear in mind. We're going to dig deeper into this to help you understand how you can actually analyze this and make sense of this as Oracle spends these massive amounts of money to build out this data center. One way that Oracle can overcome this in the short term, and the reason why the market is satisfied at the moment with the earnings that were just reported, is because of the outlook. And we've been expecting this. We're at the beginning stages of this, and now we're starting to get more proof. As the cloud business becomes a larger portion of Oracle overall, that means it's growing faster and offsetting the more sluggish growth of the legacy software business. The overall growth rate should also start to pick up steam. And you can see that in the guidance here for not just Q4 of this fiscal year, which will end in May 2026, but also for fiscal 2027, which ends in May 2027. That guidance was actually quite good, if you see that there at the bottom.
Yep. In yellow, we have that highlighted, 90 billion for fiscal year 2027, which implies a 34% growth rate over fiscal year 2026.
And so what that means is, yes, earnings per share for the time being is growing more slowly than revenue. However, it should also pick up the pace a little bit as the revenue begins to ramp up. Let's talk a little bit more about that guidance. And I think we want to address what our expectation would be. As you probably know, we have a small Oracle position. What are we looking at here? As that cloud and infrastructure software and infrastructure part of the business gets bigger, and assuming Michael Burry isn't right, assuming the whole economy doesn't get blown to bits by all this data center CapEx spending, 30% growth next year is the minimum that we would expect from Oracle. And in fact, we expect that to be even higher than that. Because of that RPO number, we'd like to see it closer to 40%. If there really is $500 billion in RPO,
it'd be easy to pull off 200 billion in revenue.
Yeah, really. And it should be. So by 2028, we fully expect this should be nearing a $200 billion per year revenue business for the period that will end in May 2028, or maybe headed into fiscal 2029. So the second half of calendar year 2028. In the past, we stated this, and now it's been garbled up because of the relationship with OpenAI and the Stargate project. But one of the drivers of Oracle Cloud and the infrastructure business was Oracle's very, very large installed base of legacy software. Remember, the total IT sector globally is $6 trillion plus per year in spending. And most of it has nothing to do with the cloud at all. It's just a lot of legacy services, a lot of licensed software that doesn't get renewed all that often. And for the vast majority of the world's businesses, that is perfectly fine. They don't want to migrate data to the cloud for whatever reason. But now that AI is a thing, they have more incentive than ever to migrate their old software and their old workloads over to something more modern. This has been, over the last number of years, the big driver behind Oracle Cloud. And overall, as the cloud and AI gets to be a larger share of the IT sector, it's going to get really big. And so a company like Oracle, as it migrates those customers over to recurring revenue models so that they can unlock the value of their data and so on and so forth, that's our expectation. 200 billion in sales. It should be very doable for Oracle within the next 2 to 3 years, let's say. I think that has to be a key benchmark for investors to watch, for all of this to make sense, to actually be a financially sound investment for all of you.
That leads to the question then, how do we analyze a company like Oracle that is shelling out so much in CapEx? Free cash flow profitability is out the window. Free cash flow in this chart is the yellow bar, and you can see that's quite negative, over 11 billion negative. Capital expenditures greatly outpacing their cash from operating activities in green. Capital expenditures in red, over 18 billion just in that last quarter. So the high rate of spending is going to have an impact on depreciation, which is going to throttle GAAP and adjusted earnings per share, which you saw in the last chart. So let's take a look at this metric. We've talked about this before when we've done some analysis on hyperscalers, CapEx to revenue, and CapEx to OCF.
Which the green one, CapEx to OCF, we can all agree that's a worthless metric.
It is right now.
It is right now. CapEx to OCF, I know that's the metric that has been talked about as of late, but the reason why we introduced this metric a while back, over a year ago, as CapEx to revenue is because the way these businesses are behaving, especially Oracle and then the smaller neoclouds, is it's a brand new industry, brand new business model built around AI. And the CapEx as a percentage of revenue is very high. they're not profitable. So CapEx to OCF makes no sense because that's for large, very mature industries where there's some stability in the capital expenditure, which is not happening right now.
And it is kind of interesting to say that about Oracle because Oracle is an established software business, but now they're making this pivot to become a high growth hyperscaler, almost like a neocloud at this point. They're trying to become that. And so it is confusing when you're looking at this and thinking, wait a minute, Oracle should be in this very stable environment.
Mm-hmm.
But they're not.
So let's break it down a little bit more because CapEx exceeded revenue last quarter. That's why it's at 1.08 specifically. So more CapEx than revenue spent last quarter. Obviously not a sustainable number at all.
And we'll just briefly look at the balance sheet. This has been brought up many, many times about the growing debt, over 134 billion in debt for Oracle, and not enough cash long term.
So you do see the influx of cash up to 39 billion to close out the quarter. Where did that come from? Remember last month, they announced that they'd be raising $50 billion in calendar year 2026, roughly half of it from debt, the other half from selling stock. They raised half of it via debt already. And so you see the corresponding increase in long-term debt in red. So that cash is going to get spent to build out more data center capacity, which is good. They completed the funding round. That was a success, but it's also going to mean more interest expense over time as well. So that's another drag on the business that you'll have to factor for later on down the road when Oracle gets through this elevated round of capital expenditure. That'll do it for this breakdown of Oracle, but don't go just yet. We have the next video right here that you should watch. What's going on with NVIDIA and that 5-layer cake that Jensen keeps talking about? It is linked right here. Check it out.